Ever have one of those days where you swear you're following your system, but end up nuking your account anyway? Yeah, I've been there. Mine usually started after a win streak. I'd feel sharp, confident, maybe too confident. Then I'd take one small loss, and suddenly I'm in make it back mode. Add another trade, then another, and just like that, I've handed back a week of gains in one emotional spiral. At the time, I thought maybe I needed a stronger edge, or a cleaner setup, or better psychology and habits. But that wasn't the problem. Here's what no one says out loud. You don't blow up because of your strategy. You'll never hear someone say, I risked 2% per trade, followed my system perfectly, and lost 50 trades in a row and blew my account. Because that's not what happens. Tilting always starts with one thing, a lack of trust in your system. Because if you truly trusted your edge, you wouldn't panic when a trade goes against you. You wouldn't force a new one just to make something back. I mean, think about it. If you back-tested your system and know that it'll give you a profit at the end, what's stopping you from just following it and letting your edge play out? You'd follow the process no matter what. But most traders don't have a process they actually believe in, and I didn't either. So I built one. Now, tilting happens for two reasons. First, as we just discussed, is a lack of confidence in your edge. It might be because you're going through a slow period and you just get irritated or bored. Maybe your eyes are starting to wander and look at other trading systems. Maybe your edge is too subjective and doesn't really have mechanical rules, so it isn't solid enough to stand on its own when you're not at your best. But whatever the issue is, it prevents you from following your system and executing your edge, which stops you from making a profit, and also makes you a prime candidate for a devastating tilt day eventually. Not good. And the second reason why tilting happens is something called the loose thread effect. Ever had a loose thread on your shirt or your socks or something, and then you try pulling at it to remove it, but it just gets worse? You yank harder and harder, and eventually you ruin your clothes. We've all been there. And that's the same psychology behind tilting, turning a small problem into something much bigger and sometimes irreversible. But I'm about to show you exactly how to end all of this and never tilt again. First, we need to fix the confidence in your edge issue, and the way we do this is by having a strict system in place before taking trades. Let's say you're looking at this chart, and you have a bullish bias. You see some bullish momentum here, so you're going to enter long and maybe target some resistance here at the previous gap. And place your stop here at the lows so you get a decent risk reward. And then it gets hit. Okay, well, now the gap is closed, but momentum is still clearly bullish. So now you might consider catching the next trade here and targeting the next resistance. And you get stopped again. Feels like the market is reading your mind and targeting you specifically, doesn't it? Well, all right. You're a bit frustrated here and you're probably about to pack it up for the day and leave your screen. But then you see the market exploding in your direction again. Turns out you were indeed right about today's direction. So you re-enter here, just to make a little profit back on the obvious move up, and maybe even end the day green. But you get stopped yet again, and then it goes in your direction again, and you get so mad you punch through a wall or something. How could you possibly mess up a move like this? You're down 3 times your risk on a trade that should have only been 1 time your risk at most. Actually, you should have been up 2 or 3 times your risk rather than losing that amount. The thing is, you were right. You just let the opportunity slip through your hands like a bar of soap. And this is a pretty mild example. I'm sure we've all experienced a day like this, and far worse. I know that I definitely have. So what's the solution here? Just use wider stop losses? Or maybe stop trading after you've taken a loss? Well, I made a really critical mistake here that basically doomed my chances before it even began. Take a second and see if you can spot it. That's right. I have no structure. I have no way to objectively measure my edge or my trades. It's all just very subjective and based on my gut feeling. Don't get me wrong, gut feeling can be a powerful thing, especially if you have experience. But what happens when it's wrong, or when your execution isn't perfect? You can't really track or backtest anything concrete, so you end up not trusting it. And that leads to situations like this one. So we need structure and we need a reliable system, one that you can backtest and rely on no matter what. And that way you can finally trust your edge logically and you can let it play out without an issue. Now for this I use something called the LCE model, which stands for Level, Confirmation, and Execution. I'll show you how it works in this exact scenario so you can see how well it improves your edge. This is the blank chart we had from before. When you look at this chart, it's kind of hard to determine where we'll go next. Will we move to the next support? Or the next resistance? Maybe we hit one and then reverse? Where do we take profit? I mean, there's a million different trajectories and possibilities, and it's hard to see a clear path here, even if you have the right bias. Trading is extremely difficult, if not borderline impossible, when you look at it this way. What we need to make this easier on us is structure. And that starts with the first part of the LCE model, which is levels. Now, these are supply and demand levels. These are zones on the chart with a high amount of volume and activity. This is where big buyers or sellers stepped in previously with size. It's basically a pocket of liquidity, and the market can't move around without liquidity. So, what the price does is, it moves from one pocket of liquidity to another. It's always searching for the next pocket of liquidity. And that's why we see this very accurate level-to-level movement. And I'll link to a video right now showing you exactly how to find them. But basically, once you have the levels mapped out, all you need to do is decide which liquidity pocket it'll hit first. Because it'll hit one of these for sure. And if you know which one is more likely to hit, then your job becomes a whole lot easier. You don't need to read market structure and try to guess the exact trajectory of the price. You don't need to guess where to target or where to place your stop. It's already done for you. You just need to make the decision. Now, although our decision making just got a whole lot easier, we don't just want to guess randomly. We don't just want 50-50 odds. We want to be objective about this so that our win rate goes much higher, and it's easy to backtest and repeat. That's how you get a real, long-lasting system with consistent profit. So this is where the confirmation and the execution part of the LCE model come in. Confirmation is just evidence that the market is more likely to move in one direction than the other. And this is how we take our win rate from a 50-50 chance to a much higher win rate, like 60 to 70%. An example could be something like buying and selling volume. So if we're at this level and we see a high amount of sell orders piling up, it means there's a downward force on the market and it's more likely to move down to this level than up to this level. We need something that tilts the odds and gives us an edge. I like to use something simple here, the 20/50 EMA cloud. This is 2 exponential moving averages, and it'll give me an instant read of the overall trend as well as momentum. If trend and momentum both point to one side, then that tilts probability to that side and we have an edge. And here we see that the cloud recently flipped from bearish to bullish, and it's now sloping up. That tilts the odds to the upper level being hit first. This is where the last part, execution, comes in. We have our levels, we have our confirmation. Now we just need to enter the trade and execute properly. You want to enter at one level and exit at the next. Now for this trade to be right, we need to hit the upper level instead of the lower level. That means we can theoretically place our stop loss all the way down at the lower level, because that's where it becomes invalidated. But we don't need to go that far before we know we're wrong. We can place it right under the cloud, near a major structural low, somewhere near the halfway point between these two levels. That's how you know you have enough distance. You give enough space for the price to breathe. But if it breaks a major piece of market structure, it probably means you should be getting out. And finally, you target the next level and simply let the trade run to either your stop or your target. Don't overthink it. That's how you get a structured and reliable trade that you can repeat over and over. This will just melt away any doubts you might have had about your edge, and will reduce the psychological urge to tilt. You have a system in place that works even when your gut feel isn't right and your trading isn't perfect. Then you just follow the mechanical rules it gives you and let that edge play out. Now, to solve the loose thread effect, here's what we need to do. You might have a trading system that semi-works, but you'll still end up going down the tilt rabbit hole if you take too many trades. If you take 10 trades in a day with bad execution and none of them work, even though they were all a part of your system, then that'll put a major dent in your account. It's basically a tilt day without being one. Not to mention that each loss destabilizes your psychology a little bit more and gives you a higher risk of tilting even further and acting irrational. We'd all like to think we're super rational, but unfortunately when you're in a drawdown or a bad psychological state, the loose thread effect means you'll only fan the flames and make it get worse. So what I do to prevent this is something called the 2-strike rule, and this ties especially well with the LCE model. You see, on the S&P 500, which is what I'm currently trading, also known as ES futures if you're trading the futures contracts, it moves around 30 to 50 points a day on average. On some less volatile days, it'll do 20, and on some more volatile days, it can do more than 100, and there is a supply and demand level roughly every 20 to 30 points. That means that a level-to-level trade will cover that amount. So on a regular day, we won't get more than 2 or 3 of these level-to-level moves, and this is great news. It means that if I follow the LCE model, I physically can't overtrade. I can only take 2 or 3 of these level-to-level trades a day at most. I can't take 10 trades or go into some major drawdown. And that's where the two-strike rule comes in. If I take one level-to-level trade for the day and win, then I stop trading. I want to preserve my profit. If I take a loss on that first trade, then I can take one more trade. If that trade is a winner, then I'll usually end break even or a little green, and I'm done for the day. If that trade is a loss, then I also stop for the day. 2 strikes and I'm out. If I took 2 losses, it also means that I got 2 level-to-level moves wrong in a row and misread the entire day. And it's probably best to stop there instead of digging my hole even deeper. I'll come back tomorrow with a fresh mind. So what's going to happen here is that tilting is impossible. Our downside is protected, and the chance of taking multiple 2-loss days in a row is extremely low. Even if it happens, our risk is under control. Most of our days will be either a win or a loss and a win, which will lead to the slow and steady growth of our trading account, with a very low risk of losing it all. So here's the bottom line. Learn to trust your edge by having a structured system in place that works even when you're not at your best. This removes the doubt and guesswork. And follow the 2-strike rule to protect your profit and never tilt again. Consistency doesn't come from discipline. It comes from structure that removes the need for discipline. You're building structure that protects you, even when you're wrong. Now, your path to profitability has no obstacles. If that sounds like what you've been missing, there's a free training below that walks you through this entire model step by step. How I use it, why it works, and how you can apply it immediately. Check the link in the description. And if you're tired of gambling and finally ready to trade with structure, like and subscribe for more breakdowns like this.